Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We begin in China, where the government said over the weekend it will not back down in the face of a renewed tariff threat from President Trump. It was late Friday, Trump suggested new levies on Chinese imports of 100%, and he also said the U.S. would impose export controls on any and all critical software beginning November 1st. Now, these moves came in reaction to China imposing export curbs on rare earth minerals. On Sunday, though, Beijing said the U.S. should stop issuing threats. The Ministry of Commerce also urged further negotiations, while at the same time saying it will not hesitate to retaliate. Joining me now for a closer look is Paul Dobson. He is Bloomberg's executive editor for Asia Markets. Paul joins us from Singapore. Paul, thank you for making time. It looks as though China is drawing a clear red line here in response to these export controls. How bad could this get, do you think?
Yeah, hi there, Doug. Well, it could certainly escalate further from here. It seems like China feels the latest measures it's put in place are already a response to the action that the US has taken over various curbs on shipments of goods and technology to China. And so the fact that the US is then escalating it again does certainly ramp up the tensions. And I think that that's why we saw a fairly severe market reaction in US hours in Friday trading. But over the weekend, the latest developments that we've seen with some comments from Donald Trump that seem to suggest there's still room for negotiations is giving the market a little bit of renewed hope as we get going on Monday morning with a little bit of a rebound in US futures. And so I think that, the market's broad interpretation of this at the moment is that both China and the US are jostling for positions ahead of a potential meeting between Trump and Xi. They both want to show, kind of what their firepower is, what they have in reserve, what they could use if things escalate. But it's telling that both of them have set the deadline for when these new measures would begin sometime in November, so after that moment when there's the possibility of this meeting. So I think that, there's a strong possibility that the market has in its mind that somebody will back down or that there'll be another compromise or there'll be a delay in more talks. At the same time, each time we get a headline that shows 100% tariff threat or something like that, the market has to react and start to price in some of the risk that may happen and that we may get another escalation and another fallout.
We heard from Vice President JD Vance over the weekend, and he called on Beijing, in his words, to choose the path of reason. And in his view, the U.S. has a lot of leverage. I'm wondering if we had to gauge here between who has more of an advantage right now. Could you say that it's the U.S., or do you necessarily think that it's China? Who has the best position here in terms of a negotiation?
China is definitely in a far better, stronger position than it was at the time of the first Trump presidency. It's much better organized and much better prepared for the escalations of these tariffs. And it holds the cards when it comes to rare earth materials, also high-powered magnets, and on top of that, some of the electric vehicle batteries as well is something that China is exporting, both the technology and the product, to the rest of the world. So that's all giving it some power. On top of that, it's causing the US some more issues by withholding purchases of soybeans, which is annoying the farmers, which is a key sort of area of support for Donald Trump. On the other side, China clearly doesn't want to be facing these 100% tariffs, and Trump knows that gives him leverage back the other way. He's willing to escalate and go that extra sort of step and that extra place that China might not be able to or might not want to. So I'm not sure that it's easy to tease out who exactly is holding the stronger set of cards here. That's the whole point of, what the sparring and the positioning and the negotiations is over. What we do know is that if they continue to ratchet it up, then everybody suffers.
Directionally, it seems like we're looking at a further decoupling. Is that right?
I think the long term, that's definitely the course, no matter what happens. You can see that both countries and both countries are carving out sort of regions within their orbit where there's stronger partnerships and looking for independence where they can from the other side. So you see that very strongly with China trying to develop its own tech sector, its own AI tech sector, its own chip makers in due course. You see that with the US looking at alternative sources for rare earth materials. The supply chains are definitely uncoupling. The areas of influence are definitely uncoupling. But it's so much, it's almost impossible to unravel, and it would take a long, long time. So there is that mutual codependence still in certain areas and the need for cooperation. And there are bigger issues as well. If you think about things like climate change that no one country can solve on its own, there isn't a need to be working together on some of those things. So, that's the reality and the difficulty of all of these negotiations. I think what the US at least wants is a little bit of a fairer price for those things that aren't those massively essential and critical kind of supplies. And that's where the negotiations will come back down to at some point.
Midweek in China, we'll get the September price data. As you know, deflation obviously has been a persistent problem, particularly at the wholesale level. Do you think that's going to be the case when these numbers are released this week, that we'll just get a reinforcement of that idea that deflation is firmly kind of in place in the Chinese economy?
China's trying to get out of that trap with its anti-involution measures, but it's taking time, and the property sector in particular is still ailing as well. So resolving those problems is a very long-term issue for China. I think, if we go back to the trade negotiation side of things, the US thinks that China is in a bit of a weak place, that its economy is hurting at the moment, and so it can apply maximum pressure through the tariffs. China, I think, is probably okay with its growth. It's still running around 5% on an annual basis, which is the target or the plan. It knows that it can do extra stimulus if it needs to get to that level. But actually exports haven't really dropped off massively despite the introduction of whatever tariffs we've seen so far from the US. They've just been redirected to other points in the world. And so China probably doesn't feel too worried, even if we have those disinflationary or deflationary measures coming through about the economy, although it is trying to take all of these steps to turn things around slowly.
I want to go to Japan next, because we had a pretty dramatic move in the market last week when talks between the Liberal Democratic Party and its junior partner Komeito simply collapsed, ending without an agreement. I mean, talk to me a little bit about the way that you view this and the severity of the situation now, particularly considering that last week we were talking about Sanae Takaichi becoming the first female prime minister of Japan.
It is so much news out there to try to get your head around on a Monday and the start of the week, isn't there, Doug? So I think that it's a really interesting situation. Today is a holiday in Japan, so it will take a little bit more time before we get more clarity. But yes, the LDP is in a quandary now. Does Takaichi try to go it alone and rule with a minority? Does she try to find new partnerships for a coalition? Or there's a remote possibility as well that the other parties could try to find an alternative PM candidate to Takaichi and circumvent the LDP altogether. So we're in a little bit of a chaotic moment for Japan's markets right now. It's completely uncertain how it will all turn out. What we do know is that a policy gridlock would be unfavorable for Japan's financial markets and most likely be negative for the equity market. What I think is really interesting is whether that turns into a positive for yen as it behaves like a haven, or whether it becomes a negative because people are worried about the economy and the sort of the slow growth that it's facing and the rising debt load that it's trying to contend with at the same time.
We'll leave it there. Paul, thank you so much. Always a pleasure. Paul Dobson is Bloomberg's executive editor for Asia markets, joining from Singapore. And the equity markets in the States kind of swooned last Friday. We had the S&P 500 down about 2.7%, its worst day in about 6 months. Coming up, we'll speak with Frances Stacey, wealth manager at Scarlet Oak Financial, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The bull market in U.S. equities is now 3 years old. It began October 12th, 2022. And since then, the S&P 500 is up, are you ready for this? 83%. And in that same period, $28 trillion has been added to market value. For a closer look now at where things stand and where we may go from here, I'm joined by Frances Stacey, wealth manager at Scarlet Oak Financial. Frances, thanks for making time to chat with me on this. What will it take for this bull market to continue, do you think?
Well, the thing is that really what we're looking for is that the markets up until Friday and up until a little bit of a breakout in volatility had kind of been ignoring all of the sort of catalysts for a sell-off. And my reasoning for that is that the M2 money stock is at a record level. So basically, there's so much liquidity in the system. It's awash with liquidity, and that is sort of the thesis behind the bull market. You also have a situation where we're coming out of September sort of stagflationary environment. You now have an amelioration, looking like it for, a continuing amelioration in inflation. And then you have the Fed taking a dovish stance based on the labor markets. And so you have that alongside the liquidity being awash in the system, and you don't have cracks in the credit market. And so I do see that it's possible that we could find some support here and go back up and retest those highs.
So we focus a lot on the big tech names like NVIDIA and Meta. To what extent has the equity market been unable to kind of broaden out or break out from the domination that these names have that concerns many people because it just kind of dominates market psychology?
Absolutely. And one of the things that's being asked is, can it be sustainable that the Mag 7 in essence has such a great, influence over the markets and the market share? The reason that has been more sustainable than anybody could have suspected, from my viewpoint, is the fact that you have an enormous amount of CapEx expenditure, capital expenditure in the GDP calculation that is AI CapEx. And so AI CapEx is actually propping up GDP. And I think that that's one of the reasons those stocks have remained, largely popular. Again, a bit of a sell-off on Friday for sure. But before that, all-time highs for most of them, except for Amazon.
So the government shutdown is another factor. I don't really know that it's been predominant in terms of a lot of market psychology right now. Maybe I'm wrong. How do you see the government shutdown fitting into this narrative?
Well, the biggest macroeconomic theme for the government shutdown is, does it threaten the liquidity flow? Does it take the liquidity in the system? Because what happened was the Fed, obviously started raising interest rates, and they, have had such high interest rates for so long relative to the last decade. You would think, well, why didn't that cause a recession? And being a Monday morning quarterback, the reason it didn't cause a recession is because the fiscal spending came in and saved the day, even though they were reducing the balance sheet and raising rates. So that fiscal spending has been what's keeping the markets and asset prices in general elevated and creating this sort of bubble phenomena. And so if the government shutdown were to go on and on and on and threaten liquidity by drastic spending cuts, that would be a catalyst for a repricing. Also, if enough people get unemployed that they have, they can't keep up with their credit card payments. We are living in a bifurcated economy where the lower 60% are living paycheck to paycheck. They don't have any savings. They're paying for groceries on credit cards. The credit card interest rates are just astronomical. And so this is sort of being hung in the balance. But if enough of these people lose their pay or lose their jobs, that you start to see a meaningful or systemic uptick in defaults around credit, then that could be a game changer.
Well, let's talk a little bit about the credit markets. We've seen some meltdowns recently. I'm thinking of names like Saks, New Fortress Energy, Tricolor Holdings, First Brands Group, all of which have grabbed some of the headlines here. But I'm trying to get a sense of what's happening under the surface, particularly as private credit is involved.
Certainly. I mean, you do see cracks all over the system. So you see an uptick of foreclosures in Florida and Nevada, primarily. You're seeing an uptick in auto loan defaults. You're seeing an uptick in late payments for credit cards, credit card defaults, et cetera, because the system and the labor market are under pressure. However, whether that results in a recession or an end to this bull market is going to be, do these credit problems, these cracks underneath, do these cause a systemic issue?
So we're going to hear from the big banks beginning Tuesday. We'll hear from JP Morgan then. I'm curious as to what you will be listening for, particularly when it comes to loans. You mentioned credit risk a moment ago. Will the banks necessarily be forthcoming on their exposure to loans possibly going bad?
Yeah, well, hard to say what they're going to say, right? But that's definitely what you're looking for, because when you think about it, when loans go bad, the banks are able to write them off of the balance sheet. But by writing them off of the balance sheet, you're actually removing that liquidity from the system. So I would be listening for any kind of any language around, if they have an uptick in defaults or they have this or that. I would be looking for language where it's so systemic that, again, it's going to interrupt this huge flow of liquidity that's had these asset prices climbing for the last, several years. 87%, you said, in the S&P 500. I mean, that's just in direct correlation to the liquidity in the system.
So with the government shutdown, we have a lack of official data, and that has made it somewhat tricky, I think, for a lot, particularly the bond market, to kind of use in terms of guidance. We're going to hear from Chair Powell on Tuesday. He's going to offer an outlook on the economy, maybe give some hints about what monetary policy may look like ahead. What are you expecting from the Fed between now, let's say, and the end of the year? Is it a foregone conclusion that we're going to get 2 more rate cuts?
That's certainly what's being priced in at the moment. I think his language is going to be dovish, more dovish. I think it's going to be in lockstep with Waller, without looking like they're kowtowing to the Trump administration. But I think they're going to, they're data dependent, and I think that they're going to find the fact set from the available data that supports the more dovish stance. And I do think it is some of these little inflections that we're seeing in credit markets, or little accelerations in credit markets, or little cracks in the labor market, that, Powell just wants to get ahead of it.
So are you inclined to be, in terms of an investment strategy, defensive right now?
I'm inclined to watch key support metrics. I always believe in hedges, However, I'm not sure that the bull market is completely over yet. Some of the data providers I look at, think that, growth and inflation are going to reaccelerate. And, so that's obviously a Goldilocks scenario. And then some think that actually growth is going to continue higher and inflation is going to go back down again in the coming quarters. So that's the trajectory we're on right now, unless we have a catalyst that, makes volatility spike, something systemic, something credit-like that, says that that's not possible. So I'd be careful, but right now I'm buying the dips.
What if we get a substantial correction in the equity market? Last week we heard from Kristalina Georgieva, who is the head of the IMF, and she acknowledged that perhaps financial stability would be at risk if this, call it a bubble, if you will, if that bursts. Does she have a point?
She certainly has a point. And we have axles and wheels, and credit cycles are not dead. Teslas look very different from the Model T, but there are still axles and wheels. And that is certainly what we have with fiat and credit cycles and business cycles. And this cycle will definitely come to an end, but it could last a lot longer than people think. And if it were to last a lot longer than people think, I would, look at the liquidity in the system, because even though that liquidity is concentrated in the upper 40% of the economy, and we are living in a very bifurcated economy, that upper 40% is consuming a lot of things. They're hiring people, they're making money, they have assets, they're spending money and stuff like that. And so that's the thing that's kind of kept us afloat.
How are you looking at markets outside the U.S. these days?
It was interesting, the rate cut in Europe, based on what's going on in Germany. I think, probably they were in growth for most of this year, but I think some of it's softening. And I think, probably they will have a rollover of their business cycle, as we will. And I don't know the timing of it exactly, but we just have a lot of geopolitical risk. And yet we have a lot of liquidity still left in the system from COVID. So it's going to be how that sort of plays out. I think it's been interesting with the tariffs, because they've, the data has trickled in so erratically that you haven't really been able to super price that in, which has actually lowered volatility in the markets. And so just watching all these factors, but credit markets are the big game changers when it comes to recessions or meaningful reversals.
So before I let you go, on the subject of tariffs, over the weekend, the Chinese government essentially said it's not going to back down from this renewed threat of tariffs from President Trump. Where is the relationship right now between the U.S. and China, and what kind of risk does it represent?
It's deteriorating. I think that the risk is going to come over a longer trajectory of time of de-dollarization. We're seeing that with precious metals prices. We're seeing that with, advances from the BRICS economy. We're seeing that, and Trump is trying to word that off with the Genius Act and trying to, make us so relevant when it comes to crypto and fiat as an amalgamation that we can compete with that. I don't know where that ends up eventually, but if for decades people tried to de-dollarize, that momentum is eventually going to catch up with us.
Frances, we'll leave it there. Thank you so much. It's always a pleasure. Frances Stacey is wealth manager at Scarlet Oak Financial, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.